first let me introduce the panel. First we have Andrew Mastripolito, the CEO of Nest Super, a niche fund servicing the superannuation needs of contractors in the electro-technology industry. Angie is a qualified actuary whose involvement in superannuation industry has spanned over 33 years. She has significant experience both as an external advisor to trustee boards and companies, covering all aspects of superannuation. She's also held senior principal positions at both Mercer and Towers Watson. Please welcome Angie. Peter Lambert is the CEO of Local Government Super. Peter also has over 30 years' experience in the super industry and joined Local Government Super over 11 years ago, firstly as the Fund Secretary, before being appointed Chief Executive Officer in December 2007. Local Government Super manages more than $9 billion in retirement savings of current and former local government employees right across New South Wales, and has a long-standing commitment to responsible and sustainable investment strategies. Please welcome Peter. And lastly, we have Scott Hartley, who's the CEO of Sunsuper. Scott was appointed as Sunsuper's CEO in January 2014. He's had an extensive career in the superannuation industry with more than 15 years' experience in executive management roles, most recently holding the position of Executive General Manager, Corporate and Institutional Wealth at NAB. Sunsuper is a public offer super fund based in Brisbane, Queensland. It was set up in 1987 as a multi-industry superannuation fund to cater for virtually all workers, and it's now over $30 billion in FUM and has over 1 million members. Please welcome Scott. So we have three very different not-for-profit funds represented up on the stage. So I hope what we'll start with actually is administration. So we've all seen that Super Partners has rolled into AIST and sort of what impact this could have on funds. Maybe if I can direct the question to you, Peter, to start with regards, what do you see as some of the issues that might happen in terms of competition, creativity, and the ability to differentiate now that there's less competition in the administration area?
Well, certainly there's less, and we probably would prefer to see another big player emerge, just from the aspect of that. But it's clearly a good deal for the clients of Super Partners. I presume this is a good deal for AIST as they've gone into it. I think the challenge is now going to be for the existing clients of AIST to ensure that this is a good deal for us as well. And that's to help manage that transition so that it's not too disruptive, but most importantly to ensure that the benefits of scale are equally shared by AIST's owners and their clients.
Very much focused on industry funds. I think there's going to be a bit of demarcation between the industry fund administrators and the retail fund administrators. Okay. And it may be to, AIST can, they will focus on making the industry fund sector providing, giving them the competitive edge. So maybe just a bit of a macro industry fund issue. I think the issue with AIST taking such a dominant role in the administration business is more from a risk perspective for the entire industry. Okay. I think while AIST, their current management are doing all the right things, are controlling quality, are controlling marketability, controlling a lot of things. The concern is that if there is a change of culture, if there's a change of ownership, the risks to the industry are enormous. And I think from a macro level, I think the industry does need to somehow control that risk. I think APRA needs to really control that risk at some point. So while things are good now, I think we just need to be very, very careful for the future.
Scott, have you got any comments? You use your own administration system. Is there anything looking out into the Super Partners AIST merger that has an effect on Sunsuper?
Obviously, that's created enormous scale. So as a self-administered fund, we have to make sure that our cost to serve remains one of the lowest in the industry and remains competitive against the AIST cost to serve model. We think we have that, and based on the sort of research that we've seen, the benchmarking data that we've seen, we sort of know we have that at the moment. But maintaining that's going to be very important. I guess as long as we can maintain that position, then we have the ability end-to-end to be able to develop our propositions, develop our technology, develop our solutions in a way that allows for us to compete differently to the AIST funds, I guess.
So, I mean, 2 points there with regards to potentially to the future of administration. Peter, do you think that there will be any view to unbundling some of these services? At the moment, I think the AIST offer is very much a bundled service. Do you think in the future that funds will look at more unbundling with regards to differentiating themselves from other funds?
Well, certainly just to take Angie's point, most industry funds will end up with the same administrator, so there is a danger we'll all look very much alike, and I think what funds will be doing is looking at all the components that an administrator does and try to identify any that they believe they can create value. We were one of the few AIST clients who decided to have our own contact centre. That was because we felt it was important that when a member rang the fund that they actually spoke to a local government super employee. Now, that's not to say that will be the same model all funds will do, but I think they'll look at all the aspects, not just core administration, and evaluate for themselves whether there is a benefit in going it alone, whether it be a specific item like contact centre or even some development outside of core admin in their software.
Okay.
It's always goes down to cost.
Okay.
So for us as a small fund, we outsource as much as possible because the benefit of being with AIST is that we access an incredible amount of scale.
Okay.
So the scale argument with smaller funds is, you've got to maintain scale to meet APRA requirements. So we access that through AIST, and we're quite happy with that at the moment.
Yes.
Again, always comes down to cost.
Okay.
If there is a cost benefit in insourcing, then we will do that. If there isn't, then we'll continue to outsource.
Scott, you mentioned before technology in administration. What do you see potentially the big changes or the impact of technology in the administration world into the future, or the next few years?
We've sort of grown up with the default system, which I don't think will continue. We expect that the default system, in the various forms that it takes, will eventually decline, and choice will take over. And in choice environment, the virtual world is the world that you have to compete in. And so digital engagement, digital distribution, retail direct capability is what funds will need, I think, in 10 to 20 years' time to be able to compete with the banks and other funds that are out there.
I would say certainly one of the real positives of the AIST Super Partners merger is the ability for funds to share in hopefully a technology spend that will allow us to more readily compete with the banks who clearly invest much greater dollars in technology than we've ever had the capacity to do. So that's certainly a positive to make sure that there is that focused spend that can occur.
So I think technology for technology's sake can be a bit of a red herring with funds. I think it's all about, again, cost benefit. Does it make it faster, cheaper, better? And does it make it more efficient for members and employers and for the fund in general? So we're a bit more discerning about technology. We'll very much look at whether there is a cost benefit to it. Again, being a smaller fund, we have to be very, very focused on cost benefit, so we don't just do things for the sake of doing it. I think the digital age has a lot of, it can be quite alluring as a panacea, but I don't think it is the panacea. I think people don't have time for superannuation. They don't, you know, if I had a Facebook, if I had an app on my iPhone, it won't be a superannuation app. I have other apps that I prefer.
Yeah. So I guess then, if we move on to technology, what are sort of some of the, how are you getting your boards across the need or not the need for investment in technology?
Again, we embrace technology where it does make things more efficient. So we've embraced intranets. Our membership is actually very technically savvy. Our membership actually install all this stuff. So
yes, I was going to say, maybe they want an app.
Maybe they need to be making sure they connect the wires properly.
Yes, yes.
Rather than looking at an app. Again, it is horses for courses, so we will look at things on their own merits. The only thing I see from an app is that it does enable messaging to a certain sector of the population, but it is a sector, I'll be a bit controversial here, but it is a sector of a population who's not that interested in superannuation in general. They probably want to be messaged about something completely different than superannuation at this point. As they age, I think it's going to be in a different world as this generation ages. They get to an age where they actually are interested in superannuation, 45, 50. I know for them it seems like that's incredibly old. But when they get to that particular age, it may be where technology actually comes to its own.
Peter, have you got any comments on that?
I think the board's, or my board's interest in technology is often being driven by sometimes frustration. Boards are wanting more concise reporting. They're not just wanting to know what happened, they want to know why it happened. And the old, dummy, spit out of an Excel spreadsheet with just raw data doesn't cut the mustard. So I think we've been sort of pushed along that journey by the board of embracing predictive modelling and starting to get those capabilities up. But I do agree with Angie, when we're sort of partway along that spectrum, probably Scott's got much more firepower than we have, so we're looking at the areas where we think technology spend adds value to our fund, typically in retention and metrics, and how we can use technology to assist in that. There is a danger, I think, as a war story. We were one of the first funds to embrace the iPad technology for agenda papers, and I look at now what's available with agenda paper technology and what we've been limping along with, and you sometimes regret not waiting a year or two and getting the second and third generation.
It seems to be the IT regret, doesn't it? Wait 6 months and you'll get something better. Yeah. Scott, there's a Kirill, your data scientist,
the Russian data scientist,
the Russian data scientist, who's not allowed back into Russia when I've spoken.
Apparently not.
Is something you've got at Sun Super and other areas. Could you go through part of that potentially?
Yeah, look, it's not all about Kirill. There's a whole team of people that do data analytics. Great guy, smart kid, and a great asset to our organisation. But there's a team of 8 people,
yes.
and Sun Super's been on a journey of data analytics and understanding our customers through data for over 7 years, certainly way before my time.
Yes.
And so it's an evolution. It's a journey. You've got to start, as Peter was saying. You've got to start and then develop your thinking and your capability around data management. So it's not all about technology. It's not all about data management. It's not all about brand, but all those things actually, for a digital direct retail business in the future, is what you're going to need to survive. So all those things need to work well together and feed each other.
Can I ask a question then on perhaps the HR aspect of the data team that you've got? Have you had to review the type of people you're trying to employ into those positions?
Yeah, sure. I mean, I'm not close to the recruitment decisions that are made there, but we've picked up a few very talented mathematics type background people that love data, and we've also got a Polish data scientist as well. There's a young lady.
Block data.
Huh?
It's Eastern Bloc data.
Eastern Bloc data is our niche, it seems.
Yeah. Which suits well to people, I think. There's a real mesh. There's a real mesh.
I can assure you they're not spies. We've tested that. No, they're good people. Yeah, but it's how all that works together. And I think the challenge that Angie calls out for Super is that everyday brand. We are not a category that people interact with regularly, particularly younger people. And the challenge for us as an industry is to, and the advantage the banks have against us, is that they have an everyday brand. People need banks, people need transaction accounts, credit cards. So they have that interaction, and they have that strong, or probably not strong, trusted relationship, but they have a regular relationship with a bank. And that's something that we have to compete with.
Do you think that the data analytics can be on two fronts? It can be sort of trying to drive internal operations to be more efficient, and also trying to look at who's our market and better break down who the member is. Is that somewhere that maybe funds need to look more so on the internal component, or is it all about trying to understand the member and that next stage of how do we connect more and become more of that?
Yeah, it's both. So the example that Kirill used at the conference the other week was that of running consolidation campaigns with our member base, and that data analytics helped to make that a more efficient and a lower cost process than it otherwise had been or would have been if we hadn't have done that. So it does have an impact on internals. The ability for data analytics, Marcoms and customer service to work well together in the messages they're sending out, who they're sending them to, and how they're being responded to in a call centre sense, or even on increasingly through apps or through email. Facebook, we serve a lot of customers through Facebook, for example, these days, and they're obviously the younger. Yeah, so we have young members who use Facebook to communicate with us. They send us messages. We have over 50,000 Facebook fans, apparently. Yeah. So, and growing all the time. But people actually use Facebook to communicate, and that's their expectation. Hey, I'm going to send you a message through Facebook. I want you to change my address or whatever it might be.
So one of the topics we brought up before, I think, Angie, you brought it up, was that members don't want to communicate about super at a younger age. Is this where we need to be communicating to them about mortgages or car loans and building that relationship? And do you have a sense of if that's more important? So to create this relationship for, as someone put it to me, when someone joins a fund, it's a 70-year relationship that you're trying to maintain. There'll be different conversations you need to have with those members all the way through that 70 years. Should this be something funds should be looking at to create that brand and engagement?
There's been a lot of money spent creating brand at the moment in the industry fund sector. I think it's been a huge spend. Does it connect people more with an everyday? It does connect with a brand, so I can acknowledge that. What do people want to do? And being young is a relative term, Tom. So
I'm very young.
So I think we're getting up to about age 45, and I think that's still young. But and what does a 45-year-old really think about during the day? Well, they think about getting dinner on at night and getting the kids, picking up the kids from daycare and all those sort of things. So if we can connect with, as Scott's saying, through the everyday, I think we have a better chance in doing that. And if it is through credit cards, if it is through banking or some sort of association with banking, we will do that because that's what they want to connect with. Unless we do that, I think we have to somehow
helicopter.
I think we get into a bit of a danger in over communicating and over bombarding, and I think we have to be really, really targeted when we talk to them, or else it just ends up in the bin. Okay. So we need to be very, very, very targeted. We don't want to be communicating too much, but when we communicate, we need to hit the spot. We don't want to be, a new term called super spam. So we, bombarding them with emails and SMSs and things like that. So I think a lot of thought has to be in the message.
Peter, do you have any comment?
I tend to sort of sit in the middle with this one. I think you do need to be aware of social media and digital trends and all of it. But I also hear that that the younger people do resent superannuation funds invading their space and trying to hijack their Facebook with messages. So
we would never do that.
we don't have the advantage of we've got alliances with ME Bank, but we don't provide those products to our members. So it's we're sort of limited in the range of conversations that you can have anyway. Engagement's just a hard slog and another topic for itself, and I think you use whatever means are at your disposal, but I don't know that the social media trends are going to be the pervasive media.
So I might then that's a nice little segue there if we start talking about engagement and maybe turn then to retention and I guess the leakages to SMSFs and retail funds, and when we were on the phone we spoke about direct investment options. Are these the solution to, one, is the big leakage to SMSFs and retail, or is it within the not-for-profit sector? And I guess as a second question, are direct investment options actually a solution? Ange, have you got?
It's been our choice not to go to direct investment options because we don't see it as the solution to SMSFs. I think there are other issues which guide members to SMSFs. I think it's the accountant and the property deals that you can do, because people love property, and it's sort of one way of using your super to do it. I think that is the goal of an SMSF through an accountant. Because we operate in the small business sector, so our contractors would have a very close relationship with their accountant. Yep. So our goal with dealing with SMSFs, or the trend to that, is to develop more personal relationships with our high net worth members, and we see that as the way to, in a sense, circumvent the advice that they're getting from their friendly accountant.
Yeah. Peter?
Certainly they're an issue. We're still sort of struggling. We're not 7 years on in the journey of data analytics to see the real trend, but I think it is slowing down. The outflows that we're looking to SMSs aren't as large, and I suspect a lot of the low-hanging fruit has been plucked. But we did take on board a DIY sort of option, or DIO option, largely because it is a functionality that you could implement at fairly low cost if you were prepared to go down a collaborative approach. So that was certainly a benefit, where you had a provider in Macquarie and an administrator in AIST who were setting up all the back office plumbing, so to speak, and allow their clients to jointly fund the costs for it. So it was a fairly low cost solution. Is it going to have a great impact? I doubt it. We don't have a huge number of people that have taken it on board, but it is something that we can at least put in our arsenal to say, if you are considering a self-managed fund, look at what we have to offer. You may get all that you want, admittedly not property, but if what you want is the ability to invest directly into the share market, you can now do it through our fund.
Scott, on the same issue of direct investment options?
Yeah, look, we've looked at it a lot over the years. We have always found other things that are higher priority to focus resources and money on. I agree with both the other speakers that it's not the panacea to self-managed super by any means, but there is some demand from some of the members for things like direct deposits, particularly as they transition to retirement. They're quite popular, is our research. But yeah, direct share trading, not so much. And people don't end up in self-managed super because they want to necessarily trade, or some, I mean a small percentage do, but most end up because their accountants advise them to do so, or their financial advisors advise them to do so, and that's the behaviour you have to get to if you want to stop self-managed. We are seeing the trend slow. We are starting to see, in fact, some self-managed super money coming back.
Right.
Where people have just said this is all too hard, or the husband's died and the husband was the one who ran all this stuff, and the wife's looking for a simple solution, and it could be the other way around, of course. But people just choosing for changed circumstances or otherwise to go back to a group arrangement.
So that was a question I was going to jump to then. Is there an opportunity for a pooled fund or an APRA regulated fund to create a really good way to bring self-managed in and take the burden of the governance of a self-managed? Is that a big opportunity for funds, do you think? Is that a first mover advantage or no?
Anyone who wants to take that on, I wish you luck. I have seen self-managed super fund administration operations in my past life. They are very, very costly, very difficult. I'm sure there's a great digital solution somewhere out there for them eventually that will make them more efficient, but you take on a huge amount of risk, and I'm not sure that too many trustees would want to take on the sort of risks you need to take on to do that.
Peter, do you have an opinion on bringing in all these self-managed into local government?
No, I can't see us going there. For those same reasons, I think you don't know what you're going to inherit. Funds which haven't lodged tax returns for the last 3 or 4 years, non-compliant investments, all sorts of skeletons that you're left to unravel. I think we've got a reasonably well-defined market we're happy to operate in. I don't see that as on our agenda.
Angie, for you?
We operate on being as simple as possible in our design, so it'd be the last thing we'd even think of. I think the best time to do it is when the property market crashes. You might have a lot less work to do, but
that's the opposite in Sydney at the moment.
I know it is. So I think we have to wait a few years for the SMSF market to mature and to go through an actual cycle.
Yeah, right. Okay. So I guess within that though, you're all saying that the SMSF flow was slowing. Are you finding that the rollouts are slowing? And if so, what do you think the reason behind that is? Or are the rollouts still there, but they're going to a different sector?
They're definitely still there, and in fact, consolidation, as we expected with SuperStream, is accelerating. So, money in, money out from a roll-in, roll-out perspective is accelerating. For us on both sides.
As in the actual volume of money moving in and out?
The amount of money, yeah. So it's accounts consolidating into their current contributing funds, and the bank's doing pretty well at it. BT's particularly active in getting people to roll and consolidate funds with their funds. ANZ are reasonably good at it. But then other super funds, for us, like Q Super, where we have a lot of interchange between Q Super members and ourselves, is doing very well as well, and we are obviously maintaining our rage on account consolidation as well.
We're really all largely doing the same thing. When someone joins the industry that we operate in, we're convincing them that it's in their best interest to join our fund and discontinue the fund they're currently in, and when they leave, we're desperately telling them it's in their best interest to stay with our fund and not join the. So we're all at each other's throats in that regard, and so the movement is there. I think most funds tend to be more successful with the retiring members, where there isn't a predator fund, and hopefully they are older people who we've built that trusted relationship with by that stage, and yes, they still may have an accountant or they would be talking to, but they've had many years with your fund and are comfortable with staying there, and really thank heavens for the retired market. If it wasn't for us, all of our funds would be just static. poaching each other's members. The real growth for us is retaining the high value people who've been with you for 30 years and keeping them for the rest of that journey.
Right. Kenji?
Oh, that churn's really interesting through the marketplace where people are just changing funds all the time. So much insurance is churning at the moment. It's just it's an interesting concept, and where does the industry end up after all this churning? Not in a better place. So, you know, it's because Peter's, you know, very correct in what he's saying. We're all just competing with each other's accounts, and as people are changing jobs, we're trying to convince them that this is our fund. So, interesting. I'd see where it all ends up, I think.
Before we move on to another component, just drop back to a comment Scott made, if I could, just going back into technology, and you mentioned both BT and ANZ, and the success, in particular, I think that BT is having in attracting new members. Is that the functionality on the iPad, that they're just hitting a button and rolling in?
Yeah, certainly the linkage with their bank account, their transactional bank account, is a seriously good link for them to cross-promote and cross-sell consolidation. But their technology is not particularly good.
Yeah.
It's really the marketing effort they're putting behind that, as well as the technology, that is enabling them to do that.
So within that, if we move on then to perhaps, you know, the role of the collective, so to speak, is there still a role for the collective of not-for-profit funds, do you think, in various guises to compete with the banks at a greater level in terms of technology, white labelling things, creating new products? Is there still a role for there, or funds need to go it alone because of their brand, what their brand is trying to say?
Well, I think there is a role for the collective. I think we do talk quite regularly. For example, the clients of AIST get together often. Perhaps we're guarded with what we do say, but I know if we are looking to white label something, the first thing I do is look at half a dozen funds of a similar size and ask them whether they're thinking of the same thing,
right.
and is there an opportunity for us to get together on that, and you know, white labelling of whether it's a DIO or DIY product, or whether it's potentially annuities and the like.
Yes.
I think funds have to do that because they just can't. We just don't have the capacity to develop these things on our own.
Scott, you let me.
Yeah, I think we better hope there's a role for collective, because, you know, if you're going to compete with the banks, with their resources and the relationships they have, the collective better get its act together and really agree on some fundamental things, and in an open and transparent way. I think that the days of being a little sort of, you know, careful about what you share are probably gone if we want to be successfully competing with the banks, and because the banks simply have so much more scale, relationship scale.
Right.
Financial resources. So, you know, if I was a client of AIST, I would certainly be encouraging fellow clients to get an agenda together that we can all sign up to, and be clear about, you know, what we're going to do with technology, for example.
Yeah.
And because if that's the only way that I think the funds can survive against the banks ultimately. They have to get together as a collective, or they get together physically to get scale, to build brands, to build relationships, to build capability to be able to take on the banks. They're a serious threat.
And from a smaller fund?
Yeah, I think the industry fund sector has moved away from representing the particular industry, and I think that's been to the detriment of their marketing. I think they've tried to be there's a sector that's trying to be a retail fund rather than an industry fund, and I think there is more success in the marketing if you could continue to associate with a particular industry. I think I think the industry funds have created their own issue there. I think they've tried to be something they're not, and they're not retail funds; they're industry funds. And at some stage we need to be an industry fund.
While we're there, is there any questions in the audience that anyone would like to ask as we go along?
Surprise, surprise.
Thank you. Colin Tate, Connexus Financial and Investment Magazine. Maybe for you, Scott, you've been on the other side of the fence with NAB and MLC. There's not a lot of open debate from the industry funds or not-for-profit funds as to where they're weak. What do you think really are the strong points of the industry fund movement as opposed to what seems to be a growing strength between the very well-resourced, very large, huge customer bases of the big banks? And I'm sure we've all had great experiences with, I've had great experiences and really terrible experiences with banks and also with industry funds. So what's your perspective maybe across the panel as well? What are the strengths of the banks really?
So the relative strengths and weaknesses. So the strengths of the banks, the relationships, the everyday brands, the everyday engagement with their customers, their financial resources and their, the scale that they have to bring to bear, should they wish to. The weaknesses for the banks are that there's clearly a lack of trust in banks, and they keep shooting themselves in the foot, in the head, quite frankly, with trust issues, particularly on the wealth side of things. They make a lot more money out of banking than they do out of wealth, which is our saviour, because they are... there have been some serious commitments. For example, Westpac have committed heavily into BT in technology development there. It'll be interesting to see how that goes, but the others have been pretty backward in terms of reinvesting in their wealth businesses. I think that as long as we can keep the services improving whilst maintaining reducing fees for members, eventually, if we do that, we do need to do that collectively, I think, then I think the banks will eventually see that the opportunity to make money out of superannuation is going to be reducing further and further. The return on investment for investing in superannuation capability is going to be much, much lower than investing in banking capability. And I think that is a potential strength that we have if we maintain that focus on efficiency as well as increasing services at the same time. It's no good to be cheap and cheerful. You've got to have good level of services as well as low cost. And that's the way I think that we can compete.
Peter or Andrew, would you like to respond to that?
Sorry, just one other thing. The bank's weakness, another weakness of the banks is they're incredibly bad at executing on big change and big projects. They waste money, they spend lots of money, they blow up, hundreds of millions of dollars all the time. They're very good at it. And I think that there is, in the industry fund side, the profit for members side, there is much more focus on every dollar we're spending and every dollar we're reinvesting, are we doing that in the best interest of members? Can we see that this dollar invested is going to reduce costs so that that dollar gets paid back in a reasonable time frame? And not having to find that shareholder margin is incredibly powerful as well.
I think there's the retail fund sector in our particular industry, because we insure people who basically live on poles and handle very dangerous things. So the insurance part of the retail fund sector is actually a bit of an issue, and people don't really know if they're insured, particularly in our industry. If they go to a retail fund, are they still insured? Because we're in a very high-risk industry. So I perceive that to be a weakness. I think their strength is their ability to go through the banking system. But we very much focus on being identified with our industry, and that the retail sector can't do that.
Can I continue that theme then, particularly on insurance, because that was the next topic I wanted to go to. As an industry fund that looks after people in highly dangerous jobs, how have you seen the current market conditions in insurance? And I guess I'll ask the same question across the panel.
I think we have not been very happy with what's happened in the insurance industry. We structured our product in coming from an actuarial background. We structured our insurance product to avoid selection, avoid huge amounts of automatic cover. We don't we see sustainability as an issue. That's coming from my actuarial background. So our conversations with our insurer have been on that basis. So we have actually been affected by the issues in the insurance industry, and that has, which we are not part of. So competitiveness is an issue, getting competitive tenders up. We've actually had a recent reduction in our insurance premiums. We have very good claims experience, and being such a homogeneous membership, it's very easy to rate us.
Right.
I think the concentrations of risk in the insurance industry on big funds, while it's great to have big funds, and it's wonderful that there's so many big funds. From an insurance perspective, it intrinsically concentrates risk too heavily, and has ripple effects throughout an industry. So I think there's a bit of a macro issue in the concentrations of risks that are happening with the larger funds and insurance companies. And you're almost getting captives now, where some of the larger funds, the insurers are actually captives of them because they can't actually move anywhere. They have to, they can't get a competitive tender up. So the insurance company becomes almost part of their organisation, and there's a very close relationship. How sustainable that is in the wider industry, I think there's a real issue.
Okay. Peter, on insurance?
Well, we've all been beneficiaries for a number of years as insurance companies have looked to capture market share. So we got some great rates, and I think it's probably led us to be a little bit lazy in the respect of, like Angie, I've been in superannuation over 30 years, and the insurance products today are the same as the insurance products were around then. Death and TPD coupled together. Long-term salary continuous. These are products that it's very difficult to see how they're sustainable, and they're forcing funds to now start looking at whether we should be uncoupling death and TPD and allowing a single person to only have disability insurance. While everything was really cheap and insurance wasn't seen as a big issue, because really at the end of the day we're here to provide retirement savings. Insurance is like an ancillary thing. We didn't do much work on the product development side. Now it's bloody expensive, and people are seeing huge amounts of their retirement savings being chewed up by insurance costs. It forces us to go back to the table and investigate whether or not we've got the right products, whether lump sums are the best way to go. Payment over 5 years might be better type of options. So a lot of work happening in insurance just to try and get that mix a little bit right, and it's probably long overdue.
And so do you think, sorry Scott, but do you think that will be the next evolution in insurance, is the product development and what's offered across cohorts within your fund?
Yeah, I think so. I think the insurance companies are very keen to try and explain to super funds how their premiums can be kept down. So there's a lot of, we're in the same boat. They want to keep the insurance. And so they need to help us find solutions to make insurance more attractive. And I think as tenders do start to roll out, as we all do them over the next 3 years, that's probably what we'll see, some people differentiating themselves on the type of insurance.
Scott, just on, I guess, on the original question about your thoughts on the current climate within insurance and maybe some discussion.
I agree with what's been said. I agree with Peter, particularly in terms of the changes to products that's going to have to occur. Lump sum, TPD is unsustainable. The lawyers are now involved, and they see that as a juicy revenue line for them. So, if we can get that to a more sensible product structure, they'll lose a bit of interest, hopefully, in that side of things. I think it is incumbent on funds, and I think all funds, the ones I talk to at least, are working on this, to think about product structures, to think about creating more sustainable products. And I think the next round of tenders and product development work that is going on we'll see changes, no
And
doubt.
do you think that will flow through the next layer down to definitions? Is that another area that has to be changed? So there's universal definitions between funds, or is that an area that you can differentiate depending on the homogeneity of your membership?
About definitions, and it can be quite semantic about, you can end up covering nothing for TPD after a while and it becomes completely useless for the member. So the TPD, you have to be almost dead to get it, which is not a good thing, and it's sort of not a good place for the industry to have come to after it has been sustainable in the past. So coming to this point is not a good thing. I think where the issue arises is in the levels of automatic cover.
Right.
I think if you tinker with the TPD definition, but keep automatic cover completely unsustainable and full of selection, it doesn't actually achieve anything. So.
Okay. I just might move on to investment fees, and there was a huge amount of this brought up, I guess, by Grattan coming into the financial services inquiry, but just on fees in general. I know discussions we've had in the past, Angie, on fees, and maybe I'll lead with you just on your thoughts around fees and I guess definitions of fees, because that's some of the discussions that we have had.
Just from my perspective, I think there's a real issue with what is an administration fee, what is an investment fee. It seems like for 80% of our costs go in administration, right? But it seems like a lot of funds actually administer themselves because they have zero administration fees. So that there is a bit of an issue in how that's communicated. And is that misleading? I don't know. I remember reading that my fund has no administration fee. Does it give the right impression with regard to the value of the fund? If it's then hidden in the investment fee, how do they then compare funds? I think it's been my view that if the industry can go to a place where an administration fee is actually truly an administration fee and funds stop administering themselves and at zero cost, an investment fee is actually an investment fee, people can actually see what that investment fee actually buys. So a higher investment fee might buy you a higher return, and you might be quite willing to do that. And that might be a good fund. And then you can see what the administration costs actually eat up. I think the way that fees are structured now, I think, can be incredibly misleading and open to advertising something which members cannot cannot easily interpret. From a, if you're looking at how a member compares a fund, I think we have to make it simpler and easier, and make it clearer. And to call it investment fee an investment fee full of administration costs, I think is incredibly misleading.
Peter?
Look, it's such an area full of smoke and mirrors, and Angie's right. Maybe we just get some guidance on what we can and can't include, because clearly everyone's stretching the boundaries as much as their marketing departments will push them to. But at the end of the day, look, it just has to be what are your returns after fees, and then forget how much of it's admin and how much of that is investment. It's whether you're delivering the after-tax return, and then we can stop comparing ourselves with Chile.
That's right.
Exactly.
That's right.
Like that.
Yeah.
Scott, any?
Yeah, look, I agree with what's said. I think you need to disclose admin fees as admin fees and investment fees as investment fees. I think generally, obviously a lot of what Grattan said and some of the comparisons they made were a bit flawed, but I think the general point that Australia is a little more expensive than other parts of the world is not lost, and I think is fairly real. In Australia, we have, in my mind, we have an obsession with active management for active management's sake. It doesn't seem to really be evidenced by the investment returns that funds get relative to what an index, diversified index, could get. So I think the analysis I've seen, rolling 10 years for the last 5, where sort of super ratings data exists and Chant West data exists, shows that the median of the industry has bounced around 10 basis points or so of the index, diversified indexed outcome using a Vanguard fund as a benchmark. But charged, it's after fees and taxes, so it's basically index return. But the perception is they've charged 60 basis points for presumably better than index performance, but on average haven't got that. Obviously, some funds more consistently get that than others. Generally, the industry funds are on the right side of the argument versus the retail funds who need to find some margin in there as well. So we should have a natural advantage.
Yeah.
And so, yeah, I just think it's interesting that we're so obsessed with active management, and I just think there's a balance that we should find.
So is the area to, if there's an idea that we should be reducing fees, so I guess if that's the premise that the fee should be reduced for Australian consumers, is investments the only area where we'll be able to drive it? Is there much fat left in insurance and admin?
I don't think there's a lot of fat in the admin side. I think that as FUM has gone up, funds have been keeping their fees relatively constant. Tend to find that what's happening is we're starting to, well, originally a few years ago we were adding compliance staff and risk staff to meet APRA's requirements. Now in a competitive market we're starting to add digital specialists and outward bound contact centre people to ring people up. So we're just forced now into this competitive environment where we can't be just a cheap and cheerful. We've got to provide services, and services come at a cost. So as long as they can be, as long as you can keep your funds at a similar cost level as you had a few years ago and providing extra services, then I think you're doing well. Look, the issue of whether investment fees could come down, I mean, all of us who have active managers all believe we're doing the right thing, so funny enough. But also, most industry funds have larger than normal illiquid portfolios,
yes.
and those illiquid portfolios are there to give diversification. And I know when I talk to our retirees at our forums that they actually are pleased to get a return that is similar to one where there's an exposure to the share market, but a percentage of their growth allocation goes into non-equity products, and I'm sure they're all looking for the payoff when the markets do turn, that those things provide the diversification. So there isn't a lot of bad news, I think, in our structures. We just don't sell ourselves all that well.
Yeah, I would agree.
I think, Tom, if I invested all in cash, I'd have a very low fee. I don't think it's the benefit of members, though. I think there's such an obsession with investment fees that we forgot about outcomes. So I know I could easily go in cash.
Yep.
My fees would be very low. Is that the best thing for members? Not really. No.
So we've got a few minutes left, and I might just choose one last topic, and that's advice. So I guess as funds, do you feel that advice is underutilised at the moment? Do members really want advice? And maybe I'll start with you, Scott, and move back.
Yeah, look, we passionately believe in advice. We think that if we could get every single member to, at an appropriate point, to get advice on achieving their retirement dreams, then that would be an ideal outcome. Unfortunately, no matter how hard you try, some members aren't going to want to get advice. We're not going to take that offer up. But advice is critical, and it's critical particularly in that sort of pre-retirement, transition to retirement phase. But the earlier the better, quite frankly. But we certainly have a lot of focus on making sure we have scale advice that can serve the needs of most of our members.
Look, I share Scott's passion for advice. We have trouble getting enough advisors to service the amount of advice that our members require, and we actually have to be very mindful that we're not there to deliver tea and sympathy. That advice is costly.
Yeah.
So we do now try to stream that advice to make sure it's delivered where appropriate. I think we're no different to a number of funds now who are looking at cheaper forms of advice and developing advice capability, more advice capability in call centres. I like the concept of people using their computers and logging in to get advice via Skype or the various applications. and also robo-advice is clearly where we've got to develop. If we are able to deliver the advice needs to all our membership, then we're woefully resourced at the moment. And there are just not enough financial planners around to deliver it all personally. So we're going to have to find other solutions. And I know someone, Vanguard, are here, and it's interesting speaking to them that all of their advice is delivered over the phone. No advisor comes out to see the person. Everyone is readily comfortable with ringing their advisor and having it delivered. And we certainly need to start to develop that mindset that our advisors are professionals and maybe less house calling them in the past.
Finally,
Tom, we try to keep things incredibly simple in our fund because it's small. So the most critical advice that that our members probably require is on the retirement space. So we concentrate on providing that intra-fund advice as necessary. It's the right, it's specialising the advice to the needs of the members. And because we keep these things simple, we have a call centre for general advice, and we outsource the financial advice model to Money Solutions. So.
Okay. Well, great. Can you all please put your hands together for a wonderful session from Angie, Peter and Scott. Thank you for giving up your time and knowledge, and thank you very much for your frankness.